If you've ever wanted to build wealth, it is about investing. It is about the time that you have in the market, not timing the market. Today's video, we're going to be looking at the investment risk, and this is going to start off and kick off the new series that we're doing, covering investments in their entirety. Now, when it comes to investing, there is a lot of different risks that you really have to keep in mind when you're putting your money into a market, whether it be in a 401k, whether it is in an IRA, or if it is something in just a brokerage account, starting with the market risk. So market risk overall is going to be the fluctuation of the market. There are going to be up days, there are going to be down days, there's going to be economic conditions when we see rising rate environments. A lot of time the stock market might not perform as well. There can also be geopolitical events, there can be market sentiment depending on the companies. Even if a company you're investing in has a lot of negative publicity, or if something catastrophic does happen within that company, you can see your stock or your investment drop significantly. But it is the same thing on that flip side. If a company does exceptionally well, has a new product, service, is winning awards, things of that nature, you're going to see your investment go up and go up considerably. Number two, we look at the volatility. This is really the price fluctuation of an investment. This is where, for a lot of people, it is very hard to stomach. When you're looking at more of the companies that are, on the S&P 500 that are larger companies, the stability doesn't change that much within the price. There is going to be fluctuation. But if you look at things like cryptocurrency can vary wildly and greatly. It is the Wild West when it comes to crypto. A lot of them, again, if you're looking at the Bitcoin at 60K and then it was at $18,000, that is massive, guys. If there was a company that actually had that kind of volatility, it would be crazy to see. I know, again, there are smaller companies that go up and down, but a majority of the stability of the larger companies are there. Number three, we look at liquidity risk. This is what can be bought and sold in the market in a very fast or slow pace, depending on what it is. Now, if you're investing something into the market, it could take a couple days. If you're investing in bonds, it could take a little bit longer. But if you look at things like cryptocurrency, if you look at things like Masterworks, if you look at things like REITs, there could be specific, depending on the company, that you have to hold the investment. Even when you look at CDs, they're not liquid without paying a penalty. If you look at annuities, if you look at a lot of different investments that we're going to be covering over the next couple of videos, there is a liquidity risk on how hard it is to buy and sell. And also, if you do have to sell it, what is the price impact of that sell? So if you buy something at $100, all of a sudden it goes down to 40, you sell it at 40. Do you have to sell it at 40 to take really the realized loss? Or can you hold on to it till it goes back up? What do you feel? And again, this is the part where it really takes a knowledge and a real stomach to invest in the market. Because if you sit there and watch your investment actually depreciate or fall in value day after day after day, a majority of people will just go ahead and sell it out at that time, and then they will be out of the market in their entirety. Now, we also do have credit risk. This is something where if you buy bonds from companies, if you look at government bonds, they can carry a different level of credit risk based on the issuer and the financial health. So when a lot of people talk about possibly downgrading the United States economy, guess what? That could make it a lot more difficult to sell government bonds, which I don't think has happened at this point. But again, there's always kind of rumors, and the same with companies. If you have a company that is, double A or triple A rated with the credit bureau, or an A plus rating with the Better Business Bureau, all of a sudden something happens, it goes down to a C. If you do hold those bonds, chances are it could be a lot more difficult to get rid of those. So you're not only relying on the credit risk that you have or the credit that you do carry, which isn't going to be affected, but looking at the credit risk of who you are getting the money from and you're buying those bonds from. There's also a big thing that a lot of people are focused on right now, which is number five, the inflation risk. Recognizing the impact of inflation of the purchasing power of money. That is right, guys. Investments with returns that do not outpace inflation will lose real value of money. Now, a lot of people, again, do not really understand this. So if you're putting something into, let's say, a CD, and your CD is paying 2% and inflation is running at 4%, even though you're making 2% on your money, you're only covering half of the inflation that you're kind of subject to. So as you're buying things, you're actually spending more money, which means that your investment needs to be making 4% or higher for you to be net positive. And again, big picture thinking, this is something you do have to keep in mind. Interest rate risk is the next one that we look at number six. Interest rates can be drastically different, guys. Even looking at the beginning of 2022, 5-year CDs were paying about 0.6%. Now you can look and you can actually get a 5.5% or even 6% investment that is guaranteed in a CD for about 9 months. So it's kind of crazy to see that the 5 years was at a 0.6. Now we're seeing 9 and 12 month CDs at 5.5, 6%. That is the impact of really the interest rate risk that you're running. Lower bond prices can really drive down the interest rate as well. A lot of people deal with treasury bonds. Again, that can fluctuate pretty well when it comes to the rate. Number 7, we look at the political and the regulatory risk. Again, that is something that is huge when it comes to the crypto community. Even looking at the possibility of Coinbase leaving the United States because of the regulation that is going on. That, of course, would have a huge impact when it comes to cryptocurrency, the ability to trade it, and even some countries that have banned cryptocurrency with the buying and selling going outside of the United States. I know most recently, KuCoin had the KYC verification. If you're in the United States, unfortunately, you cannot verify unless you VPN. So there is regulation that has literally pushed a lot of those cryptocurrencies off of shore. Number 8, we have currency risk. Now, this is, of course, the fluctuation of currencies within an investment. This can be relevant if you're looking in international markets. If a country goes to war, who knows what could go and what could happen to your investments overseas. It is something to keep not only the currency risk, but also the international investments in mind when you're doing this. Diversification is the final one, guys, which is my absolute biggest one. This is the reason exploring the benefits and spreading your investments across different asset classes will reduce your diversification or increase your diversification, but it will also mitigate your risk. Now, what do we mean by this? When you look at the stock market, there's a bunch of different sectors that kind of make up the stock market. If one sector, let's say technology, has a huge impact negative where technology stocks start to plummet, you could have other sectors within the S&P 500 if that's what you're investing in. That is going to be able to carry or make up some of that risk or spread out some of that risk. This is where a lot of people say, if you're looking, again, big picture at portfolios, if you put some in stocks, if you put some in bonds, if you put some in, let's say, real estate, you put some in cryptocurrency, you put some in fine art, there's a lot of different ways that you can diversify a portfolio to really make it and minimize the impact while continuing to growth and while continuing to earn money within that portfolio. These topics, guys, again, we're going to be covering the investment side for probably about the next week or two. Let me know in the comments what you guys think. If you like the content that I provide, definitely consider subscribing to the channel, and I will catch you in the next video.